So the next one is what we call the iron condor credit spread. So basically, it's just going to be the combination of your bull put credit spread and the bear call credit spread together, and there should be equal distance between the strikes, of your underlying security, and your expiration series should be the same. Okay, so basically, you're short. You have two credit spreads and two option contracts two spreads that you're putting together. You're using the long iron condor is ideal for premium collecting where you want to seek to minimize your losses. Then it moves against you, but it's going to again take advantage of time decay and volatility and that probability analysis of if you're selling out of the money. So it can be broken down and looked at and viewed as a bull put credit spread with a bear call credit spread. So if you feel the stock or security is going to trade in a tight range between two strikes, between two areas of support resistance, and stagnate, then this is a great strategy. Again, if you have some good tools that kind of can help you make that judgment call. So if you've got good solid resistance up here, and then you've got good solid support down here, then this is a great strategy that you do what we call the iron condor. So you sell credit spread, a bear call credit spread, and a bull put credit spread to play that range. And you can increase your potential returns that way. And the other great thing is these are great for legging in and legging out. So you don't have to do it all at once. The market goes up, for example, and then it has a cycle, start coming off. So it goes up, cycles down, then you sell that bear call credit spread, comes back down, starts turning up, sell that bull put credit spread, and then you create what we call the iron condor. So a great way to leg in, leg out, and adjust your risk that way, and take advantage of, theta decay and volatility. So there's your structure, what it looks like. So it's a combination of two credit spreads. So this would be an example of short a call, long a call. So there's your bear call credit spread, and then short a put, long a put, and there's your bull put credit spread. So you've got those two. So, let's say you make, $50 credit here, $50 credit here, you've got a total potential then to make $100. And let's say the spread width is 200, so you've got that, bigger potential profit, and then you can leg out. So let's say you got into the bear call credit spread here, comes back down here, and you say, okay, let's go ahead and take profit there. You can leg out, close that one out, and you're still in the bull put credit spread. You can go back and forth. So it's a really good way to play a range in a market and take advantage of, kind of range bound markets, which we've been in quite a bit actually. So here's an example of Google. This one we had on the sideways kind of price action on Google. So it was trading, you can see it had been in this range here, this upside range, and then this downside range down here. So kind of right in here, so you can see it had been back here trading like that range. So this was taking advantage of that kind of range in here. So the upside, downside, really good support right there. So when you have good solid support up or down, or resistance, this makes a good kind of setup for that kind of trade. So here's the trade setup, and this was then a combination. You do it all at once or leg into it. So this was selling the 105 put short buying the 100. So you're short that 105 put, long the put below it. So there's your bull put credit spread, brought in $40 credit there. And then here's your bear call credit spread, was selling the 114 call right here, buying the call above at the 118 to cap that risk. Okay, so you have two different credit spreads on, but with this credit spread, you brought in a total of $90 credit, $40, and actually brought in $92 credit. Okay, so that's your potential profit, and this one ended up going out and making the max profit of $90. So 30% return in 13 days. So your downside is limited to the spread width less the total amount that you bring in. So that's the an iron condor.